Today he have shown inclination that whatever challenges we are facing for managing the investments for the future of our child, he'll be taking us through what are the different products that we have for the investment, what are its benefits, and how we can plan our child's future better. So, best of luck to Dipesh, and over to you now. As we discussed, you can mute all of us now, and after the session, you can take up all the queries.
So, sure.
Okay?
Yes.
Chalo,
Yeah,
thank you.
sure. Thank you. Thank you, Dhanashree, and welcome all. So, my name is Deepesh Mehta. I'm from Bangalore. Just a statutory disclosure that please don't consider this as an investment advice. The whole objective of this session is to educate you, and nothing of this should be taken as an investment advice. Okay. So let me get started. So I'll start this with a small story, and this story was there in ancient India. So there was an elephant, and then there were six men, and all the six men were blind. And they were asked to touch one part of the elephant, and then they were asked what is it. So neither they knew that it was an elephant, nor they knew that what it is. So the first man who touched the spear, he told that it's a weapon. The second person who touched the trunk, he said it's an snake. The third person who touched the ears, he said it's a fan. The fourth person touched the leg and he told it's a tree. The fifth person touched the stomach of the elephant and he told it's a wall. The last person who touched the tail, he said it's a rope. Unfortunately, these people were blind men, so they couldn't realize, what actually was there in front of them. Likewise, friends, we have to look this elephant in an holistic way. And when I say this, sometimes we also fall blind to some of the things that we look from a child's investment point of view. Something which looks very lucrative, we end up signing up that instrument and then realize that this is not the thing that we have to do. So the content of this session for today is that, we will understand what challenges that parents face, what common mistake that parents make while investing, smart tips that every parent should know while investing, steps to kickstart your child's future and gain momentum, and then the final summary. We'll end this session in about 35-40 minutes. We'll try to end this as early as possible. Okay. So most of us earn decently well in our profession. We all agree to that. Whatever profession that we are in, we are doing much better. We are at a certain class that we belong to. But we fail miserably when it comes to money management. So we do have skills in our profession, but we fail miserably when it comes to money management. So can we make our child dreams come true in spite of these challenges? So what we research? We research buying the latest mobile user reviews. While buying a car, we do test drives. When we have to go for a vacation, we look at travel portals, TV shows. When we have to admit a child to a school, we check our neighbors, university, and other things. But when it comes to investments, what we don't research is investment planning for child's education. And this is the biggest problem that all parents have. Okay. Some misconceptions to bridge. So people who don't plan, that is how they think. The popular way, this is what most common parents do, that I'll take a loan when I need to fund and then pay an EMI. Why I have to pay it now? Why I have to plan it now? Some parents say that I have a great insurance policy. Few say that I have real estate, which is sufficient. And some people say that I have enough money making in my profession that will help me to take care of it. But the ideal way should be that instead of looking for a loan, we should actually invest regularly every month. You should know that insurance is to cover risk and not an investment. You should understand that real estate serves a different purpose and not as a plan for your financial goals. You have to understand that you have to balance between your today and tomorrow and hence make money from whatever that you earn. You should not be assuming that your income will take care of your expenses forever. So the first challenge, these are the challenges that parents face. The first challenge, I'll give this with an example. Assume you had 200 rupees. In 2013, you could, as a family, you could buy this whole pizza. In 2017, for that same 200, you could buy only this pizza. 2019, you could only buy half of this pizza. And 2022, you could buy only this pizza, and then in 2025, you could buy only this pizza. So what is happening? The power of that 100 rupees, which had the power to buy so much of pizza for us, can now buy only a half of a quarter pizza. So this is the challenge that we have, which means that the impact of inflation is actually impacting us. So cash generally depreciates. So this is the challenge, and I'll connect that how the challenge is related to our child. And then there's one more challenge, that this is the lifestyle inflation that affects on us. Many years back, you could have bought this 500 rupee shoes. Now you need this kind of shoes. There's a 500% rise in cost. We all agree to this. Many years back, a small theater would take care of our entertainment needs. Now we go to a multiplex. The minimum cost is 250 rupees per ticket, and the price is 400% jump in the aspiration. You all remember our Indian, couple story where a couple used to go in Bajaj Chetak. Now we need a family car, minimum a family car, which cost about 5 lakh rupees minimum. There's a 900% rise in the aspiration. Few years back, we used to go to a small vacation, which was costing 50,000. Now we take international trips. There's a 900% rise in cost. So if you see, the aspirations have actually gone up for us. This generation aspirations have actually gone up from what our parents had actually, lived their life. Similarly, this is the approximate cost to raise a child, and this is the source from Economic Times newspaper. Your children between age 2 to 4 in 2011 you used to spend 4.86 lakhs. In 2025, 7% increase, you need to spend about 12.5 lakh rupees. 5 to 9 years child, you need 20 lakhs. The child's age between 9 to 12, you'll spend about 24 lakhs. Child's age between 13 to 16, you'll spend about 29 lakhs. And the child, when it comes to graduation, you'll spend about close to 55 lakhs. So if you see, from 2011 to 2025, in 14 years, what has changed? And we all agree that if, we all have children, we have a child who's between 1 year to 3, 4 years, and we all know that this is the amount that you already spent for nanny, for the babysitting, for diapers and other all the stuff. So the reality is that going forward, all the expenses for the child is certainly going to go up. It's not going to remain there. It's going to go up. This is the challenge that we have. The second challenge that we have is that the taxation impact on our income. At least 50% of what your CTC is already taken away. I'll show you how. So if your income is 150 rupees, you pay 33 rupees tax on 150, which means you pay 50 rupees tax. So the net disposable income that you get in your bank account is 100 rupees. On this 100 rupees disposable income, you for various goods, you pay 18% GST, so 15 rupees is reduced. So the net effective money that you have is only about 85 rupees that you could actually spend. This is the second challenge that we have. Now, both these challenges, the challenge of inflation and the challenge of taxation, are unavoidable, and you can't actually go and ask your employer that please don't deduct my taxes, or you can't go to the school and say that reduce my fees to 50%. You can't do all those things. So these are things which are not in our control. Okay. So the question that I have to ask for you is that when is the right time to invest for your child? I need some answers here. If you could actually put a one-word answer on the chat box, when is the right time to actually invest in child? People who are on YouTube can actually answer there in the comments. I need some answers if you could actually answer this. My question to you is when is the right time to actually invest for a child? So we do have some answers coming in. We have as soon right now. Okay, good answers. Good answers. So let me just tell you the answer for this. The answer for this is the right time to make the investment for the child is the moment the child is born, or in our case, the moment the child is adopted, and then you get a birth certificate. This is the right time. And I'll show you what mistakes we are all making. The first mistake that we make is starting investment late. Let me show you with an example what happens when you start investing late. What happens to the power of compounding? It is lost. So let's look at this number. Say your child is just born today, 1 day old, and let's say you start making 10,000 rupees investments every month. So in 20 years, you will invest for 240 months, assuming that it grows about 12% per annum. You invest about 24 lakh rupees, and this 24 lakh grows up to, let's say, about 1 crore rupees. So nothing is lost because you have maximized the time duration. But if you delay this by 1 year, And instead of 20 years, instead of 240 months, if
Another
you
noise.
have, can you all mute in case if you could do? So in case if you delay this by 1 year, then the final value that you accumulate is only about 87 lakh rupees, about 12.5% of what you could have accumulated is lost just by delay by 1 year. And if you delay by 2 years, about 23% of your wealth is lost because you have only 216 months to compound. And if you delay by 3 years, that's about investment duration is only 17 years, then 33% of the money what you could accumulate. So here, if you could accumulate 1 crore rupees for 20 years, you could accumulate only 66 lakh rupees. So what I wanted to tell is that one third of the wealth is lost just by delay by about 3 years. This is the biggest mistake that the parents are already making by delaying the investments. And let's understand why this delay comes. This is due to the power of compounding. Parents want the maximum investment corpus to be built given by giving minimum amount of time. Parents say, give me the highest returns and I can invest only 2, 3, 4, 5 years. Realistically, this cannot happen. I'll tell you why it can't happen, because while investing, you can control the time element and not the return element. Return is not in your control. You cannot go to the bank and say that give me 15% return. If you're investing in mutual funds or shares, you cannot say that I need for 40, 50% return. It is not in your control, realistically. But people try to chase returns, ignoring the time element. So this is a wealth creation formula. This is nothing but the compound interest formula that we learned in class 3 and class 4, which our children will learn in next few years. The compound interest formula is equal to final amount is equal to principal into 1 to the 1 plus r by 100 to the power of time. What parents generally focus is on returns. Where can you get the maximum returns? What parents generally ignore is the time factor. That they don't give time, but they expect the maximum returns. Please note, this is not in your control, but this is in your control. You can do it today whenever things are in your control, and then leave some time for it to grow. Okay? Another popular mistake that people make is buying or considering insurance as an investment. Puja, buying or considering insurance as an investment. So what happens generally, we end up buying you end up buying an insurance plan. When you actually buy an insurance plan assuming that an investment, it's basically tying your left lace with your left right leg. If you tie that, and if I ask you to run, then what happens? Your speed is not as normal as what you could run normally. The same way happens with insurance come investments. If you actually make an investment into those policies which have insurance come investment, then your returns will not be more than 5 or 6%. So this actually uh, lowers the growth of your investment portfolio that you earmark for your child's higher education. And please remember, if you want to plan for your child's education, it's not necessary that you should buy a policy which should have the word child into it. No, parents should read between the lines. It doesn't mean that for your child, you have to buy a child policy or a smart kid or something like that. Keep insurance separate and keep investment separate. Don't merge them together. Mistake that and then the third mistake that people do, parents do, is that they depend on education loans. Look at this difference here. If you do your own arrangement versus you make an arrangement from your bank loan, where is the difference? Let's say you need 1 crore rupees when your child is 18 years old, and assume that your child is 3 years old, then you have 15 more years to accumulate this. If you make an investment which assumes a 12% return per annum, the monthly investment required is about 20,600, and the total money that you invest is about 20,600 into 180 months. So you invest about 37 lakh rupees, and the amount that you accumulate is about 1 crore, where the gain is about 66 lakh rupees. Whereas if you take a loan from a bank, what happens at 10, 11, 12%? The monthly EMI that you pay is about 1,25,000 rupees, which ends up burdening your child when you actually take up a loan, and you pay a lot of interest rather than earning from the compounding factor that you already have. So if people think that there's going to be a student loan, education loan when my child turns 18, so let me not plan today, then that's the wrong way to actually approach for your child's future. When you depend on loan, what happens? You don't in your own arrangement, you earn interest. When you borrow, you actually pay interest. In your own arrangement, you don't mortgage. Here you mortgage. Here, small investments when pooled will compound and become a big number. Here, huge EMIs are required to pay for the borrowed money. Here, you don't burden with debt. Here, you burden with a debt trap. No costs are involved when you invest. You pay mandatory charges, all these charges, you know. You benefit from the power of compounding. If you don't pay EMI on time, you pay the compounding interest. Here you have peace of mind. Here you have stress due to anxiety because you have to ensure that you have a good running job in and to actually pay the EMIs. This is the mistake which parents make by assuming that let me depend on the loan. The fourth mistake that the parents make is that they follow herd mentality. Now I'll show you what is this. So basically, there's a small opening here, and one sheep came in this way. So all the other sheep wanted to come this. If you look into this, what is happening is this is a herd mentality. This is a sheep mentality that one sheep went into a small narrow passing, and everybody wants to pass that. Parents also make the same mistake that one parent said that I bought this land outskirt of so and so city, and then everybody wants to. But somebody said that I bought this LIC policy, and then everybody wants to do that. No, it is not. That is not how you actually have to look. Everybody's preferences, everybody's life stages are different. What your friend, your colleague, your relatives are doing, not necessarily that is the right thing for you. So hence, don't make the mistake of following the herd mentality. It actually doesn't suit you. Your profile is different. Your friends, your relatives, your office colleagues' profile are different, and you should not be following this herd mentality. The mistake number five is that giving lame excuses. So some people say that let us start from next financial year. Our last vacation is on EMI, so I'll think about investing when I complete this. We need to paint our house, so let me do it next Diwali. The next iPhone model will launch, I'll buy that first. We need to ask our auditor when if we can invest. We need to upgrade our car first, then everything else can be thought later. Let me get a promotion. Time is not right auspicious. My business needs funds. I somehow need to manage my child's expenses. I don't have time to plan. I have a companion on credit card that could pay my child's college fees. I'll inherit some assets. So these are some of the excuses that people give, but really all these excuses will only derail your child's future, and there's no real outcome that you'll get from these excuses. So the moment the salary comes, so today is the first week of the month. The moment the salary comes, you have car EMIs, you have home loan EMIs, you have credit card bills, you have grocery bills, you have maids and cook expenses. My question to all of you is that where is your child's investments? Ideally, the first outflow that should happen is that you should actually prioritize your child's education planning. Let's say the moment you get your salary, from your salary, the first outflow that should go is for your child's education expenses. You set aside some money, and that means you invest, plus your other important goal like your retirement, and then you actually have to prioritize these other things. But if you actually do the other way, where you spend these things and whatever is left out at the end of the month, then you will not have any money left out in your bank account at the end of the month. That is for sure. Okay. There is no person who has succeeded saying that I'll invest at the end of the month, whatever residual money is there, because that residual money never remains there. So let's calculate the child's future education expenses. I have a small calculator, and I could actually showcase you this calculator to share. And okay, if your child's age is, let's say, 3, if your child's age is 3, and 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 if your child's age is 3, and then let's say at the age of 18, you actually need money, and if the current cost of education is about, let's say, 50 lakh rupees, and if you actually calculate this, then you need about 2 crore rupees. A 50 lakh education will cost you about 2 crore rupees. This is the cost of education that you have to keep in mind. Okay, so I'll again move back to the screen. Um, Hope I'm audible. I'll just I'll just take a break. 1 minute. Puja, I'll just take a break. There is an lag in the sound. Live recording. Just a minute, friends. There's a small error. Yeah, I'm back. Just a minute. So am I audible? So there's some small error here. I hope this is audible and I'll just resume this. Okay. Then the smart tips that all of you should know. Now I come to what you should actually do, understanding that you are making those mistakes and facing those challenges. The first thing that you need to do is you have to apply the 80-20 principle. So this was given by somebody, which says that an example to that is that 80% of the sales come from 20% of the customers. So 80% of the income tax is paid by 20% of taxpayers. Similarly, in our context, when it comes to child's investments, it can be applied here as well. So if you invest 20% of your money and give enough time for compounding, the compounding will add 80% of the balance. So when I say, what do I mean by this is, let's say you want to accumulate a crore rupees when your child turns 18 years old, you only have to invest regularly every month, and only 20% of your investment is what you actually have to put from your own side. The balance money will get compounded, and that is what the 80-20 principle says. It works everywhere. It works in the compounding thing as well. Unfortunately, people start late and hence they end up contributing only 20%, and the rest 80% is what they take the bank loan. The second smart tip that you need to know is that you actually need to create some envelope habits. Okay, this is a mindset thing. So the moment you get your salary, you set aside money for your child's school fees, your child's higher education expenses, and if you want to set aside for your child's marriage expenses, you can do that. So the moment you do this, what is happening is that you are actually compulsorily setting aside money towards your child's education expenses. The moment the salary comes or the income comes from this salary, please do this. And then the other tip that I have for you is that understand the rule of 33, 33, 33. What does this rule say? Is that your investment should be equal or greater to 33% of your take home income. This is very important. Whatever is your salary, whether it is 50,000, 1 lakh, 2 lakh, 5 lakh, 33% of that salary, you should actually save that money and you should be living only on 66%. Now, where you should spend that 66%, your total EMI should not cross 33% of your income. The moment your EMI crosses 33% of your income, you'll have more challenges because you'll not have money left towards your child's education expenses. Neither, if there is an issue with your job, then you have to deal with paying with a lot of EMIs, and your expenses plus EMI should not cross 66% of your take home income. You have this formula, and then come what may, whether a new wave of COVID comes, if other challenges impact your job, you will not have any issues because you would have saved substantial amount of money towards your future expenses. Smart tip number four, understanding risk versus returns. While investing, you need to balance between safety and returns. For your short term needs, you should be investing in instruments which will offer you safety. And for your long term needs, you should be investing in those instruments which will be giving you higher returns. So, for your short term needs, you should not be risking any capital. So, let me give you an example. Let's say you want to admit your child in an school where you have to pay a donation of about 2 lakh rupees. Okay, and this has to be done in June 2025. Now, this money should never go into equity markets or any other instruments which have a lot of volatility. So, hence, you should look at putting that money in a fixed deposit, liquid funds, or in retain that money in your bank account. So, you should not be risking that amount of money. Whereas if you have to plan for your child's future expenses, for your child's graduation, post graduation expenses, in those cases, you have to look at investment instruments which will have the potential to beat inflation because your cost of expenses goes up by 7-8% every year. So your investment should give you returns higher than that. Okay. Smart tip number five, understanding investment options and how do you have to use them effectively. Okay. So globally, there are only six investment asset class that one can invest. Okay, whichever form or shape that you take. The first asset class is real estate, where you can invest in commercial and residential real estate, and this is not meant for child's education expenses. Then the other asset class is commodities like gold, silver, other ornaments. Some of you can invest some money in gold bar coins. The other one is the art, which some set of people do invest, but this is not meant for child's education expenses. Then I'll first touch on this investing in other businesses, alternate investments, bitcoins, venture capital. Even this is not meant for child's education expenses. What are the two popular investments that you should look at is one is the fixed income instruments. When I say fixed income, any instrument which gives you interest, like your employee provident fund, PPF, bonds, debt mutual funds, post office scheme, bank deposits, Sukanya Samriddhi scheme, all these come under fixed instruments. And then the other asset class should be equity asset classes, which could be shares and equity mutual funds. So your child's investment plan has to be in between these two, and then a portion of this can be added. You should not be looking at other asset classes. You should not be thinking that I have Bitcoin, so that will take care of my child's education expenses, or I have this real estate that will take care of my child's education. No, that is not the way you should look. Mostly for child's education, you have to look at regulated financial instruments which do not evaporate or erode just because there is some issues with respect to markets. That is how you actually have to look at this. Okay. Now I'll give you one thing and one challenge to you and one beat to you. Let's say there is, and this is, I'm going to explain this. So let's say you have about 30 crore rupees with you, and each you have about somebody gives you 1 crore rupees per day. So each day you get 1 crore rupees. For 30 days, you get about 30 crore rupees. And there's one more deal which says somebody gives you 1 rupee and then double this every year. So every day. So 1 becomes 2, 4, 8, 16, 32, 64, 128, 256, 256. If we do then whatever money gets accumulated at the age of 30, on the 30th day, that is yours. Given a choice, which one would you choose? A guaranteed assured amount of 30 crore rupees, or 1 rupee starting on the first day and doubling this every year, every day for about 30 days. So I need some answers from you. So many of you are replying. So I'll just repeat this: 1 rupee, 1 crore per day for 30 days, you get 30 crores. Versus you start from 1 rupee and then double this every day: 1, 2, 4, 8, 16, and then whatever get accumulated at the age of on the 30th day is yours. So we do have some answers. So let me reveal what is the answer here. So the answer is that if you start with 1 rupee per day and then double this every day, in 30 days you accumulate about 107 crore rupees. And the starting point was just 1 rupee. The point that I wanted to tell you is that the in that first deal, till 25 days, the first deal accumulated 25 crores, 1 crore per day into 25 days. But in the second deal, till 25 crores, you didn't see, if you add all the stuffs, till 25 crores, you didn't see any meaningful value. The actual compounding happened on 26, 27, 28, 29, 30. Why I'm bringing this point is that let's say your child is 2 years old, and at his age of 18, in 2025, your child is 2 years old, and then in 2041, your child will become 18 years old. When you make your regular investments every month, till the child turns 13, 14 years, you will not see any meaningful amount accumulated. But the real returns will come in the last 3, 4 years of the time when the actual money is needed, and that is what the compounding is going to come and help you in building your child's future. So don't look at something which is assured, saying that okay, I'll get this so much, so let me put into that. Please understand the compounding benefit. It actually works a lot in life. So comparison of different asset classes. So some of the popular asset classes which parents invest. So I'm making a comparison. So one popular asset class is equity mutual funds. The suggested time horizon is 7 years plus. The returns expected could be 12 to 15% per annum. The disadvantage of this is you have market volatility. The advantage is that it beats inflation because the inflation is about between 7 to 10 percentage. So this kind of portfolio gives you returns higher than inflation. PPF, 15 years is the lock-in period. The rate of return is 7%. And you have a lock-in period. And then the advantage is that you get a tax-free return of 7.1% accurately. Sukanya Samriddhi for parents who have girl child. The suggested time horizon is 14 years. You get 8%, but it doesn't beat inflation. And it is tax-free still. LIC is some people do it. The time horizon is 10, 15, 20 years. And the returns that you actually get is only about 5%. It doesn't beat inflation. The advantage is nothing here. The child's insurance plan, these are the common policies that your banker sells you, and this suggested time horizon, depending on the age of the child. The returns that you get is only in the range of 5 to 7%. It has high charges to beat inflation, and There's no advantage for this. So these are different products, and I'm going to tell you which products to use at what phase of your child is in. Okay. Now, when I say equity mutual funds delivering 12 to 15%, why does it deliver 12 to 15%? Like, where does 12 to 15% return comes? So when you invest in equity mutual funds, what happens is that your money is being invested into shares of different companies, diversified across different sectors like auto, banks, cement, finance, pharma, power, software. So as consumers, let's say 150 crore people consume toothpaste, consume shampoo, then the stocks of Hindustan Lever would go up. If people use Colgate, then the Coca-Cola stocks of Colgate is people drink, then United Spirits will go up. Likewise, if India is a consumption-driven economy, if India will do well in the next 10, 15, 20 years, the stocks of the listed companies are going to go up. And that is what you can expect that kind of return on your portfolio. That is how you make money through equity mutual funds. I'll not touch more on this, but I'm just trying to tell you that how this 12 to 15% return gets generated. Okay. Now, result of investing in right asset class. Now, this is very important. Assume that the cost of higher education is 25 lakh rupees today, and inflation is 10%. And so that means today, if you admit your child to a graduate to an engineering course, it will cost you 25 lakh rupees, and inflation is 10% per annum. And assume that your child's age is 2. So you need fund after 16 years. That means child's age of 18, 16 years from today. Now, the cost of education after 16 years will be 1.15 crore due to inflation. So every year on 25%, 10% is added as inflation because college cost goes up accordingly. So you need about 1.15 crore rupees when your child turns 18. So if you look at choice number one, an investment which beats inflation. So let's say you invest 20,000 a month. If the expected return is about 12%, which is 2% greater than inflation, and then you do an investment for 16 years from child's age 2 to child's age of 18, the accumulation will happen to about 1.16 crores. Another choice where you make 20,000 investment, but let's say you decide to put in an instrument which gives you 8% return, that means which is 2% lesser than inflation. In 16 years, that's 120, you accumulate only about 78 lakhs. So what happens? Your need is about 1.15 crore, and then you have only about 60, 70% accumulated of what you need. That means that is what it happens when you actually invest in instruments which actually don't beat inflation. So you should look for a child where you have a decade long time horizon, then you have to look at instruments which will give you good, decent double digit returns. Anything less in single digit will not actually help you to build a good corpus for your child. Investment options if your child age is below 10. So right now, if your child is below 10, and 10 is a number, I will tell you border number, I will tell you why it is. So if your child is less than 10, the first thing that you need to do is you need to discover your risk profile. Some people can take high risk, some people can take moderate risk, some people can take low risk. Now, this is depending on human to human. And it has to be done through an advisor, and its objective to find out how much investments you could invest in volatile assets and how much investments you need to invest in fixed assets, which will give you a short return. Once discussed, finalized, for every 100 that you invest, split this money into a fixed ratio. Let's say if you're a high risk investor, you could invest 70% of your money into volatile assets and about 30% of money into fixed asset classes. And example is what I told you. And start investing in the above manner. This is what you need to do if your child is below 10. If your child is above 10, in this age category, you need to invest. You need to have an investment which have decent exposure to bonds apart from equities. Why is that so? I'll tell you that. Say, let's say at the age of 18, child needs money. And if your child is less than 10 years, then you have good time frame to actually build money. But if your child is age 10, 11, 12, then you have only few years. So you can't invest more amount in volatile assets. So you have to actually mix and match between equities and bonds. And at the age of 17, 90, 80, 90% of the money should go into bonds or fixed deposit or fixed income instruments, and only 10, 20% should go into equities. This is the right mix that you should have, depending on what age of the child that you are investing in. How to plan when you decide to when you plan how do you plan if you have to send your child for abroad education is that abroad education will have dollar related instruments. That means you have to invest in instruments which actually invest in dollars. So the options to invest abroad is through fund of fund through mutual funds or dollar denominated investment through LRS scheme of RBI. So every person can invest up to $2.5 lakh abroad. This is the option that you have if you plan to send your child outside India for higher education expenses. So 7 steps to kickstart your child's education. The first thing that you have to do is that you have to clean up your investment mess. So most of you would be having like this, that you would be running your child's education using the square wheels, and you are blindfold towards making the square wheels to round wheels. So if you are having square wheels, then your child returns will not actually give the way it is. So please fix the instrument that you are investing in. So it's time to actually do that. That is the first step. Second step is ladder your investment loans. I know most of the couples, would have gone through IVF route and would have taken some loans and other stuff. So pay off all those loans, which is charging you higher interest. So for this is what you need to do. Close those loans which have the highest interest rates and then close it accordingly. So you ladder up those. So and then the only loan that you have to continue is only the home loan EMI, and apart from that, no other loan should continue. And then understand the golden pyramid. The first thing that you need to do is that you need to draw a financial plan, that what is that you wanted to achieve, a blueprint of your future. The financial plan should be drawn, and then you should take life insurance for yourself, not for your child. A term insurance. You should write a will, power of attorney, a disability and health insurance should be taken, and then you should start looking at education saving, your retirement, any other personal savings for wealth creation. Then you should look at home and debt reduction of home loan. And then finally, you should look at high risk equity investments. And finally, you should look at other riskier investment, art, gold, bitcoins, and other stuffs. What people do is that they don't have a proper financial plan in place. They only just go and mirror what their friends, relatives, or somebody said that I bought this Ethereum Bitcoin, Ethereum crypto, or that Bitcoin, and then people do that. Or somebody said that I gave a loan to my friend, which is going to give me 3% interest. Don't do that. You actually have to follow this approach. If you follow this approach, nothing can go wrong. You only have to first cover the basics first, and then accordingly ladder up. This is the way that you actually have to move your money. And step four, fulfill your child dreams. Ensure that you are adequately insured. You should be having a term insurance. Whatever is your CTC into 20 times is the insurance that you should be having. So if your child is dependent on you, then if both of your working parents or whoever is a working parents, that person should be taking 20 times of your CTC as your term insurance. Prepare for emergencies. You may lose your job. Then how are you going to pay for child school fees? So you have to prepare for that. Understand your time horizon, that how much time you have for each goal. For your vacation, you have only 6 months time. For your child's education, you have 15 years. For your retirement, you have 30 years. So you have to actually understand your time horizon. Estimate the cost of education using a good calculator, and assess your risk profile. Understand your existing assets and know your goal, and know the amount to be saved to reach your goal, and then make the investment. Then last step is ring fence your investments. So have a term insurance so that you don't have any issues coming in, and write a will, appoint a guardian for your minor child. If both the parents are not there, then who's going to take care of the child? So do that, and preserve all your documents safely. To summarize, start planning early, be realistic about the cost, instill good financial habits in yourself and for your children if they are grown up and if they can understand this. Invest in a range of skills for yourself. Take a term insurance and a family health insurance. Protect yourself from disability insurance. Remember, invest first and spend later. Think long term and invest for long term, and have a financial advisor. That's it from my end, and a little bit about who I am. I promised that I'll complete in 45 minutes, and this is what we have done for this. So, about me, I am a certified financial planner and I have 18 years of experience. And Puja, and we offer investment services to different life stages. I'm basically from Bangalore, and like this. I've conducted more than 200 financial literacy sessions. I live with my family, my wife, and my child in Bangalore. And I've also published this book, which is I've also written this book, which is published by CNBC TV 18, and this is the book. It's currently out of stock everywhere, and the new publication can come in another 4 5 months. But this is what I am, and that's it. This is what we are, and happy to have any questions. And thank you for your time and attending the same. I'm very much active on LinkedIn. In case if you guys are on LinkedIn, please do connect. Yeah. So if anybody have any questions or anything, that please feel free to ask. And whoever don't have questions could actually drop out. So If there are any questions, we could look. Is NPS Vatsalya a good option? Yes, NPS Vatsalya is a good option. But NPS Vats, okay, I'll tell you what is NPS Vatsalya. So you have NPS for adults, which is a normal NPS. The government introduced something called as NPS Vatsalya. That is NPS for your children. This is for child's retirement. So my advice to you is that unless you have not fulfilled your own retirement, please don't look into NPS Vatsalya. But if you're done with your retirement and child's education, then definitely you can look at NPS Vatsalya. Yeah. And yeah, any other questions? You could also ask by unmuting yourself, or you could put this on the group chat as well. So I guess we don't have any questions. So again, thank you so much. What age is the best to educate kids on finance? Very good question. At the moment, you should actually instill financial habits in your, like how you instill other habits to your child. You should also instill financial habits to your child. The moment the child's start understanding this, and that you could start giving him a piggy bank, and then put some money, and then finally open a bank account and take the child to the bank and show him that this is how the banking system works. So whenever your child is mature enough to understand, you should actually start, but do it as early as possible. The moment you realize that you should do it. The next question that is I see FD can double the amount over a period of time. Is investing in mutual fund a better choice? So Michelle, the doubling concept has to we understand that at what time it should double. Maybe when I was 8 9 years old, post office were doubling in 7 years and 2 months. So now an FD or a post office doubles in about 14 years. So basically, there is something called as rule of 72, which I will explain this to you, and this is very important. So if you divide 72 by um, percentage of returns, let's say you get 6% return in an FD. So 72 by 6 is about 12 years. So the answer of this division, 72 by 6, tells you in how many years money will double. 72 by 6 is about in 12 years money will double. So if you go to a bank and if the bank gives you 6% interest, and then you can calculate and tell that it's going to double in 12 years. So this is something called as rule of 72. 72 divided by the percentage. So let's say if you get 12% return, then in 6 years money doubles. Generally, in equity mutual funds, you double the money in about 12 years, in 6 years at 12% return. But though this is not a sure guarantee it's going to happen in about 6 years, but this is what past 40 years, 35 years data has given this to us. To understand this rule of 72, another way to actually look at is 72 by 10 is if inflation is 10, then the cost of your child's education will double in 7.2 years. If today the child's education is costing you about 50 lakh rupees, and if your child is about 11 years, then when the child turns 18 years old, at 7 years later, your child's education will cost you about 1 crore rupees. So the rule of 72 is what you actually have to learn. These are the smart tips that you actually have to know. And whatever presentation that I did was an extract from my book that I actually wrote this. So a detailed version of there is there in the book. And then any other question? So this session was very helpful. Do you perform sessions for corporates? Yes, Surya, I do. We do this. So every month we do have 2 3 requests. I don't take more than 2 3 sessions because our core job is to manage people's money. So, but 2 3 sessions in a month is what we do. When Mahimo they ask is investment in post office scheme Sukanya Samriddhi a good option? I have a different view here, and some of you might not agree to this view. See, Sukanya Samriddhi originally was brought for that segment of the people who said that she's a girl, why should I make an investment for she? Anyway, she's going to get married at the age of 18. So the government introduced Sukanya Samriddhi and said that please be invest for your girl's child education. But if you believe but if you don't think in that way and you don't differentiate between a boy and a girl, and if you see that there's going to be about 15 years of time horizon for your child, then give that 15 years to instruments which will give you much higher returns than what Sukanya Samriddhi would give. But finally, it is subject to individual choices, and it's up to you, depending on your risk profile. Is NSC a good option to invest? NSC is good, government guaranteed, but the returns on NSC are taxable. So if NSC gives you 7%, then you have to deduct, let's say if you fall in 30% tax bracket, then you pay about 30% tax. So your net tax return is about 4.9% returns. This is what you get post-tax. So in an investment, the most important factor that you have to look at is that what is my post-tax returns. Equity mutual funds have a return of about have a taxation of only about 12.5%. You might be in 30% tax bracket, but when you withdraw from a mutual fund, equity mutual funds, you pay only 12.5% as taxes. Yeah, fine. Any other questions? Um, So I think that's it from my end, and I hope you guys love this, like this session, and this will actually help you to build your child's future. We are all, as I said, we are all in the same boat. Long way to go. We have just got our child with us, so then let us hope that our child have enough money for his future expenses, and he don't have to depend on anybody to build his own career. That's it. Thank you so much. And we will all stay in touch with you. Thank you so much. Thank you once again. Yeah. So I'm ending this session in the next few seconds. We'll stay in touch in the in different WhatsApp groups. Thank you so much. Yeah. Yeah. I'm ending this session now.